You're all welcome to our webinar today, hosted by the Nevin Economic Research Institute, called The Birthplace of Aircraft Leasing, Ireland Aircraft Leasing and Tax Arbitrage. So we are delighted to be joined by Doyle Doyle and Jim Stewart. Thank you, Killian and Jim, so much for presenting with us today. Killian is a policy advisor at the Houses of the Oireachtas and a final year PhD researcher in the School of Business at Trinity College. His research interests include shadow banking, the IFSC, and Ireland's tax-driven approach to industrial strategy. His paper forms part of a larger research project on the Section 110 tax regime, and his previous research has been published in the Journal of Financial Regulation and Compliance and Critical Perspectives in International Business. We're also delighted to be joined by Jim Stewart, who is currently an adjunct professor in finance at Trinity. He was formerly an associate professor in finance at Trinity Business School, and he has researched and published extensively in the area of finance. And his current interests include corporate taxation, multinational enterprise tax strategies, measuring effective tax rates, offshore financial centres, and shadow banking. He has a PhD from the London School of Economics and an MSc from the University of Stirling in Scotland and undergrad degrees from Trinity. So we are delighted to be joined by you both. Thank you, Killian and Jim, so much. Just a few announcements before we start. The meeting is being recorded, but it will just be recorded for the presentation part of the seminar. Once that's done, we'll move to Q&A and discussion, and that won't be recorded. The recording and the slides will be uploaded on the NERI website once the seminar is over. And just a couple of announcements to bring to your attention as well is that there's a number of really interesting events coming up for NERI. Its 13th annual NERI Labour Market Conference will take place in Ulster University in Belfast, and that's on Thursday the 29th of May, all day from 10 till 5. There'll also be two further online seminars like this one on Wednesday, the 11th of June from 3:30 to 4:30. And Paul Goldrick Kelly from NERI will present on the relationship between institutional configuration and emissions per person in certain OECD states. And a further webinar on Wednesday, the 5th of November from 3:30 till 4:30 also. And the presenter will be Kevin P. O'Kelly, the Industrial Relations and EU Social Policy researcher, and he will present on the impact of artificial intelligence on employment relations, a European study. Okay, so all these details are on the NERI website. So we're going to kick off. I know that Killian and Jim are going to do a kind of tag team on their presentation, starting with Killian, I think, who's going to talk more to the macroeconomic aspects, and then Killian will hand over to Jim, who will speak more specifically on the case of Section 110 firms. So we have, let's say, 45 to 50 minutes for this, and then hopefully 10 minutes for Q&A. So I'll give you a kind of 5-minute warning, guys, if that's okay. Thank you very much. Handing over to you, Killian.
Great. Thanks very much, Nessa. And hello, everyone. And thanks for coming along to hear me and Jim present our paper. You can see the title there. It's The Birthplace of Aircraft Leasing, Ireland Aircraft Leasing and Tax Arbitrage. I suppose just to give a bit of background, this paper is a third installment of a kind of a wider project, a research project that myself and Jim have been engaged in. This research has examined kind of shadow banking in firms that are operating in the IFSC and which are availing of the Section 110 regime. For people who mightn't be familiar with the Section 110 regime, it's a kind of a tax and regulatory incentive for firms that are engaged in certain kinds of shadow banking activities and largely operating within the IFSC. The attraction of Section 110 finance is that, I suppose, kind of interest on loans are kind of tax deductible in a domestic Irish perspective, which can be used to kind of eliminate taxable profits, but they can also be kind of tax exempt in the kind of the recipient foreign jurisdiction because they can be deemed kind of after tax distributions. Just by way of background, Section 110 was introduced in 1997 to kind of facilitate a market for securitization within the IFSC. And the first paper that myself and Jim looked at was kind of a Section 110 securitization vehicles, which encountered difficulties during the great financial crash of 2008. And the connections that those vehicles had to kind of a number of US and European commercial and investment banks, which encountered difficulties, failed, or required significant kind of taxpayer bailouts. The Section 110 regime has been kind of continuously expanded since its introduction, and it now kind of encompasses a kind of a broad array of kind of shadow banking type activities, from kind of structured finance, intragroup lending, and of course aircraft leasing. And the second paper we looked at was kind of Russian connected vehicles that were operating in the IFSC and that were being used to kind of raise finance for Russian multinationals. So these were kind of, state-owned enterprises, your Gazproms and your Rosnefts, and also kind of privately owned firms, variously engaged in the banking sector or the extractive industries. And that paper had kind of highlighted how Section 110 had been used for kind of sanctions avoidance and also potentially kind of illicit financial flows. So this is the third installment of our research into Section 110, and it's looking at the aircraft leasing sector's use of the regime. It's important to kind of note at the outset that not all of the aircraft leasing sector uses Section 110. We're only examining kind of one subset of it, which we can kind of describe as kind of Section 110 kind of leasing vehicles, and they probably account for around maybe 20% of the population. So our findings that we're presenting here today, we're not making a claim about the leasing sector as a whole, but it's possible that the findings are consistent with the leasing sector, but we're not necessarily making that claim. I suppose why these firms are of interest is that well, one, obviously the leasing sector is very big, but Section 110 is a very valuable kind of tax incentive for firms. And if you like, on the other side, I suppose, of the ledger, it's also a very kind of costly tax expenditure for the state. And that Section 110 firms, as I suppose the previous two papers that we've done probably indicate, have certain kind of interesting kind of risk profiles, which make them kind of worthy of investigation. So I'll come on to that in a moment about why that's kind of motivated our paper and what our paper looks at. But just first, I'll just give you a bit of a quick kind of a structure for our presentation. I'm going to give you a kind of a quick background on the global aviation industry, how aircraft leasing kind of relates to that, and kind of where Ireland's kind of place in that lies. After that, we'll kind of give an outline of the paper, of our kind of study population, how we identified firms, what was our data source, how we treated that data, and any kind of issues that were arising. Then I'll come on to the kind of the domestic impact of the leasing firms, because I suppose one of the things you hear from, perhaps from industry or from government sources is that the sector tends to be a kind of a good contributor to employment, both direct employment and indirect employment, and also to tax revenues. So we kind of will assess kind of some of those claims. Then Jim will come in on Section 110 loans as a kind of a key fiscal incentive and an attraction for the IFSC for kind of large lessors. We'll discuss Jim will discuss then the international aviation treaties. The leasing sector kind of relies on two important kind of UN conventions, the Chicago Convention and the Cape Town Convention, which kind of helped with the functioning, if you like, of the global leasing industry. Those kind of conventions now are kind of threatened, if you like, because of kind of geopolitical risks. And as I'll come on to in a few minutes, Russia's kind of seizure of a number of leased aircraft, valued up to say 15 billion, which are kind of still trapped in Russia. So that kind of creates risks for the kind of the future enforceability of these conventions, which the global aircraft leasing industry kind of relies. Then in terms of our study population, Jim will detail kind of the profitability, kind of gross assets and financing aspects of these firms, as well as their interest payments. They tend to have quite high interest payments, which could represent perhaps in part kind of profit extraction, or perhaps artificial kind of constructions rather than kind of market-based interest rates, and how that relates to an EU directive, the hybrid directive. And lastly, then we'll just touch on organizational structures of Section 110 firms and kind of local expenditures, and then we'll kind of offer some conclusions. Just by way of background, people might be too familiar with the global leasing, but the aircraft leasing or the airline industry, I suppose in general, is quite a cyclical one. It's one that generally kind of tends to follow the business cycle. When people have more money, remember that they travel more, and and conversely, if times are bad, they travel less. But there are other factors which kind of impact this kind of cycles of kind of or demand shocks. We might think of them as. So there's kind of interest rate shocks, oil kind of price shocks, wars, terrorism, and I suppose kind of most recently you can see pandemics. So these can have a big impact on airline travel. And how that impacts leasing is that leasing allows kind of airlines much more flexibility in how they manage their fleets and how they can kind of change with how they can cope with changes in demand. Now, the sector didn't really exist before the kind of the 1970s. This is at a time, I suppose, airlines really kind of just purchased these kind of large capital assets and kept them on their balance sheets. But today, leasing is integral to the industry. About 50% of the global commercial fleet is leased. And if you look at Ireland, Ireland has about 60 to 65% of the kind of the market share of the global leasing industry. Ireland's kind of two closest competitors are Singapore and Hong Kong, which are again kind of similarly kind of lightly taxed, lightly regulated, kind of small kind of financial center type locations. Figure two just shows the kind of the growth there in commercial fleet. For Ireland's relationship to leasing, people might be familiar with it. I mean, it kind of goes back to kind of Guinness Peak Aviation, Tony Ryan, later of kind of Ryanair fame. GPA at one point was the kind of the largest leasing company in the world. It had a market share of around 36.5%, which is very big. This was kind of before a kind of a failed IPO and kind of a subsequent collapse, and it's taken over by kind of GE Capital, which GCAS was the kind of the leasing version of that. But nevertheless, Ireland's kind of maintained that connection to the leasing sector. And it's often kind of referred to in kind of IFSC strategy documents as a kind of a flagship industry for Ireland. Ireland has certainly attracted like the top global lessors. I mean, 19 of the top 20 global lessors are now based in the IFSC. And the central bank describes Section 110 as being kind of one key attraction in that. I mean, there are other factors. I mean, Ireland has a kind of a generous, depreciation regime as well. But Section 110 is an important factor. On a more, I suppose, kind of general level, I mean, the industry is kind of described as being kind of a significant contributor to the economy through kind of job creation, through revenue generation, and through broader economic impacts. So we'll come back to that in a moment just to see is that the case. In terms of specifically of our paper, we're kind of looking at aircraft leasing and risk, and in particular the risk of using kind of Section 110 vehicles. As I'd mentioned kind of earlier, the aviation industry, the global air leasing industry relies heavily on kind of these two kind of UN international treaties. These treaties are important because they separate the financing of aircraft from the managing of aircraft. So a lot of aircraft will be financed from Ireland, but they might not necessarily be managed from Ireland. They could be managed in another jurisdiction, like Bermuda, the Cayman Islands, or perhaps like in the US, um, or something like that. These two treaties are also very important because they deal with, say, the event of default, how quickly an aircraft can be repossessed. They kind of tend to supersede kind of domestic law, and they also help to kind of mediate in disputes between kind of creditors and debtors. But due to the kind of the seizure of these aircraft, Russia's seizure of aircraft following the imposition of sanctions, this raises kind of questions as to the future enforceability, of these treaties. Russia itself was a signatory to both treaties. So I mean, it's possible now that I mean other countries could act similarly in the future in the face of sanctions. So this creates risk for the aircraft leasing sector and could increase the kind of future cost of leasing. So those kind of geopolitical risks are kind of compounded by when we're looking at Section 110 firms from their kind of very high debt to equity structures. These tend to be very highly geared firms. You can kind of finance a Section 110 leasing firm overwhelmingly from debt, with as little as kind of one dollar paid up equity. So that they're risky in that sense. Like other, I suppose, kind of shadow banking type firms, those risks aren't always kind of well understood because of the kind of the complex structures that the firms use and the kind of complex and kind of financing structures that they use. An example of this is that they tend to use what's called an orphan structure. This involves kind of the use of kind of common law legal conventions like trust and charitable trust structures. This kind of separates kind of ownership control and indicates that the firm has no kind of legal parent company, even though it is likely to be subject to control. So I suppose, in the face of all that, these firms are kind of quite risky. As we'll see, there's kind of quite low employment, quite low corporate tax havens, but they're nevertheless kind of benefiting from very, very valuable fiscal incentives in the form of Section 110. So, in the face of a kind of a cost benefit analysis, it's something that kind of probably needs kind of closer inspection. The data source that we are using for our paper is the company registration office. So the statutory filings that they make with the CRO, so your financial statements, your annual returns, and the likes. Identifying the firms is probably the trickiest part because that involves a lot of kind of trawling through the CRO, looking for kind of leasing firms which met our criteria, which I'll come on to now in a second. But having identified firms, then we would extract kind of relevant information on their profitability, financing activities, domestic expenditures, ownership structures, and the likes. We had two criteria, I suppose, to establish whether kind of firms were in our study, whether they met the standard, and that was whether they were charged at the rate of 25% for passive income. Most kind of leasing firms in Ireland will be charged at 12.5% for trading income. So if you were 25% and you had issued what's called a PPL, it's a profit participating loan, and sometimes referred to as a junior note or subordinated debt. This is a type of hybrid financial instrument which combines elements of debt and equity. If you had those kind of two criteria, then you were included in our study. And we collected data for the period 2010 to 2021. So this resulted in a study population of 350 firms. We did come across firms that were non-trading. We of course excluded those, and we also came across instances where kind of Section 110 leasing firms were subsidiaries of other Section 110 holding companies, and instances like that we would have excluded the subsidiaries just to avoid the double counting. There's just some kind of data/treatment issues. We did come across instances where you had Section 110 holding companies which were also consolidating kind of non-Section 110 subsidiaries. We have included those just to note that. And it's also worth noting that the data that we're using is kind of subject to kind of accounting conventions and changes in accounting rules. Lease accounting is quite complex, it's controversial, and there can be different rules in play. So, say, for example, between Ireland and the US, there might be a difference in when a capital profit on a sale is recognized, how a kind of a sale and lease transaction is organized. So it's noted as being kind of a complex and controversial area. There are also kind of timing issues which are worth flagging. There's a lot of variability in when companies had their kind of financial year end. There are also plenty of instances where firms might submit their accounts late, maybe a year, 2 or 3 years late. So how you decided on when you're kind of assigning certain transactions to a given year, that required some judgment. Disclosure information, I suppose, that is also worth mentioning that there wasn't a kind of a uniformity in the level of disclosure in relation to certain kind of information that would be quite useful. So, for example, the jurisdiction of the lessee, where they are, sometimes that might be disclosed. Sometimes it might be disclosed like on a kind of a regional basis. So they might say that the person leasing the aircraft is in Asia, or sorry, that the firm is in Asia. Sometimes it's not disclosed at all. There were times where they might disclose the number of aircraft that are held. There were plenty of instances where that wasn't disclosed. So if there was kind of greater disclosure there and more uniform disclosure, it'd probably lend itself to a kind of a deeper analysis of some of those aspects. Then again, just I suppose the use of kind of non-transparent ownership structures and kind of multiple layers of kind of intermediate companies and parent companies, often kind of spread across several jurisdictions, similar jurisdictions to Ireland. You see like Luxembourg, the Netherlands, Bermuda, stuff like that, which could make it difficult sometimes trying to kind of to go up the chain to identify where the who the ultimate kind of parent company is. There's also a number of kind of leasing firms which were organized as external companies. This means that, that these were kind of operating as branches, but they could be managed elsewhere, and they don't file audit accounts with the CRO. Figure 3 here. This is just a snapshot of 2018, where you can kind of see who the ultimate parent company or controlling or sponsor is by industry sector. I mean, as you would imagine, the lion's share are aircraft lessors themselves, but there is some kind of used by private equity firms. The large kind of private equity firm Carlyle, that they had purchased a kind of a mid to upper tier lesser called Apollo Aviation a number of years ago. There's some stuff by sovereign wealth funds. DAE is a subsidiary of the Dubai Sovereign Wealth Fund. So there are kind of other types of industry sectors, but it's predominantly it's aircraft lessors. In terms of, I suppose, these aircraft lessors, the benefit, the kind of the domestic benefits in terms of their contribution to employment, there's a kind of a good bit of variability there in terms of estimates for kind of employment. What you see here is the green line is estimates for kind of direct employment and indirect employment. The blue line is the CSO's estimate for direct employment, and the orange is other industry sources for direct employment. Now, the CSO, I think probably was the most reliable source. They ran a series from 2008 to 2018, which was kind of unfortunately discontinued thereafter. But they noted that for direct employment by aircraft lessors, it never reached 2000. It was smaller than that. I think it reached a high of maybe around 1700. Other industry sources, you can see SMB Capital there. They put that figure in around the same thing. So it seems to be quite small in terms of direct employment. In terms of indirect employment, this is when you're talking about, creating work for, say, like, auditing or legal advice. This tends to be a bit higher. And PwC, they had a report there a number of years ago. Sorry, not a number of years, but like 2 years ago, which got quite a lot of coverage. They estimated that that the sector contributes about almost 9,000 in terms of full-time equivalent jobs for both direct and indirect employees. Now, there's certain issues, I suppose, with their methodology, which kind of our study kind of highlights. They use a kind of a job expenditure job multiplier to arrive at their figure. But I suppose, as our paper kind of highlights, a lot of the expenditure by Section 110 leasing firms is accruing abroad. So kind of assuming that a lot of their domestic expenditure takes place in Ireland, I think gives an exaggerated picture of their kind of contribution to indirect employment. I suppose in terms of indirect employment, as I said, it's auditing is a big kind of a beneficiary, and the top five auditing firms accounted for around 75% of our population of Section 110 leasing firms. So if that generalizes, you can see it's quite narrowly the beneficiaries are quite narrowly concentrated. We did take time to look at each of these kind of firms. So you obviously got the big four auditors, I think, plus Grant Thornton. They reported about 334 employees directly employed in their kind of auditing aircraft leasing firms. So again, that's quite small in the grand scheme of things, and I think probably highlights that the PwC estimate might be a little bit on the rosy side. The same thing with the law firms. The top five law firms accounted for about 70% of our population. So again, if that generalizes, it indicates, kind of quite a concentrated number of beneficiaries. And those law firms reported 52 employees that were kind of directly involved in aircraft leasing. So those employees and partners. Now it's worth noting that these firms also probably have employees in other kind of functions that overlap with aircraft leasing. So you could add that on top of that again, but I still think it's consistent with kind of low aggregate numbers for employed in the sector. And just turn on to as well just to tax payments, because that's that their revenue generation is the other kind of domestic benefit that the sector is kind of cited for. This is revenue data now. This is not ours, but I think it certainly kind of complements ours. They looked at over a 6 year period, kind of the leasing sector contribution to kind of gross and net corporate tax receipts. It's kind of just important just to flag, I suppose, prior to 2021, they weren't actually including Section 110 leasing firms in their study. I don't know why that is, but they have subsequently included them. But they have noted that they're excluding firms which have no corporate tax liability, which is a bit peculiar, because Section 110 firms are structured to be kind of tax neutral. So if you're going to include them but then exclude firms that don't have a tax liability, it's a bit inconsistent. we noted that I think in the year 2020, around 60% of our Section 110 leasing firms had no corporate tax liability, or they reported a loss. I just draw attention, I suppose, then just maybe to the right hand column here, the difference between net corporate tax receipts and VAT. You can see that, I suppose, in the years 21, 22, and 23, that VAT refunds actually exceeded net corporate tax receipts again. So that kind of just raises questions about how much of a kind of a revenue generator the industry is. And that data certainly aligns with, I suppose, our own kind of Section 110 study, which shows that, most firms in most years had no corporate tax liability. So I might just turn you over now to Jim. Jim, can you see that okay?
Thank you very much. Thank you very much, Kenny, for that very comprehensive introduction. This section focuses on fiscal incentives for aircraft leasing, particularly firms that use a tax incentive introduced in 1997, Section 110 of the 1997 Finance Act. So I'm going to elaborate on some of the main points that Killian's made. This was specifically extended in the Finance Act 2011, Section 40, to include as qualifying assets, plant and machinery, commodities, and certain carbon offsets. Aircraft leasing, however, was the main beneficiary because leased aircraft and aircraft engines was accepted as plant and machinery. Now, just to explain that Section 110 loans are valuable in raising finance because the interest paid is tax deductible in Ireland and may also be tax-free to a non-Irish resident. This is because interest paid may vary, but in most cases does not, and is treated as a profit distribution which tax has already been paid. These loans are termed a hybrid financial instrument and are subject to a BEPS action report and an EU directive because of the risk of double non-taxation. Aircraft have properties which result in far greater liquidity and lower risk than other real assets, and it's not surprising that this high liquidity means Section 110 and other debt finance is used to finance aircraft rather than less liquid plant and machinery. Next slide, please. The effective seizure of leased aircraft in Russia, with an estimated total insurance claim of 8 to 15 billion, has drawn attention to aircraft leasing and international treaties. And there are two key treaties, as Killian has mentioned. The Cape Town Convention from 2021. The most relevant part of the Cape Town Convention is specifically designed to meet the requirements of advanced structured financing to give certainty to the rights of a creditor to repossess qualifying aircraft after a specified time period. The net effect is that means that domestic courts and legislation relating to insolvency procedures for aircraft leasing firms are not applicable. The main convention, however, is the Chicago Convention. And the Cape Town Convention related solely to disputes between debtors and creditors. The Chicago Convention, agreed in 1944, has been described as the foundation of modern aviation, which made a true global international aviation network possible. Next slide, please. It requires aircraft, the Chicago Convention requires aircraft to be registered in only one state. This state then ensures compliance with the rules of the Chicago Convention. The Chicago Convention provides that the state of registration and the state of operation may sign a bilateral agreement which transfers responsibility for regulation and safety to the state of the operator. This is extremely important for centres of aircraft leasing such as Ireland. It means the majority of commercial leased aircraft that are owned and registered in Ireland have key functions, for example, maintenance, taking place outside Ireland in the state of the operator. Next slide, please. Now, in particular, the international conventions and treaties have been attention has been drawn to by Russia. Sanctions imposed by Russia by the European Union following the Ukrainian invasion required all aircraft leases to end by 28th of March 2022. Russian aircraft operators did not return leased aircraft, resulting in an immediate breach of the Cape Town Convention. Leased aircraft were re-registered in Russia in contravention of the Chicago Convention. In 2022, there were an estimated 500 foreign-owned aircraft leased to Russia. Approximately 330 of these were owned by an Irish leaser with an estimated value of 3 to 5 to 4.5 billion. In 2021, 17 of the Section 110 firms in our study had leased aircraft to Russia. They reported asset write-downs of 313 million. 7 firms reported losses and other write-downs greater than 50% of assets. Breaking international leasing conventions by Russia and the possibility that other countries in particular circumstances could follow poses additional risks to all aircraft leasing firms. It could be viewed as part of the breakdown of a rules-based international trade and investment. And we should note that the Trump administration has been particularly hostile to certain UN conventions and treaties. Next slide, please. Just the hybrid directive is interesting because it could have posed a threat to Irish aircraft leasing industry, but did not. A proposed directive on shell companies, on shell, could have directly affect leasing firms in Ireland. The main tax advantages of Section 100 firms, as I mentioned, it stems from a mismatch between the tax treatment of interest payments in Ireland, which are tax deductible, and the tax treatment of those interest payments in another country where they're not taxed. This can result, as we noted, in double non-taxation. A key part of the hybrid directive are restrictions on the level of interest that may be tax deductible. The detailed rules as implemented are complex and reflect lobbying by interest groups. PwC, for example, in its submission to the Department of Finance, argued for an extension of the definition of interest paid to include interest income on all forms of debt and other income economically equivalent to interest and income earned in connection with the raising of finance. As a result of this and other clauses, Arthur Cox has stated that most transactions involving Section 100 companies will be unaffected by the new rules because of the way Section 100 companies are established and governed. Next slide, please. Now, particularly in fiscal incentives, the two main corporate tax rates, as Killian has noted, 12.5% applies to leasing firms. The leaser is regarded as being in a trade or leasing, otherwise, 25% applies. In addition to Section 110 loans, all aircraft leasing firms may avail of accelerated depreciation allowances of 12.5% per annum on a straight line basis. The value of Section 110 loans depends on double taxation treaties that ensure income capital gains can be paid to a relevant country but will not be subject to foreign taxes. Section 110 tax status is self-declared. There are rules, but little evidence of revenue audits of Section 110 firms to ensure rule compliance. All administrative functions of Section 110 firms are performed by a corporate service provider, a CSP. As Section 110 firms may organise as a holding company which raises funds which are lent to subsidiaries while preserving Section 110 tax benefits. Next slide, please. Now, I want to particularly draw your attention to external firms. Many Section 110 firms operate as an external company. That is, they're a branch in Ireland of a firm registered in another country, generally Bermuda or the Cayman Islands. The branch is taxed as if it was an Irish resident firm. This structure could be described as a reverse double Irish. So you're registered in another country, but you're taxed in Ireland. That is rather than being covered in Ireland, taxed in Bermuda, the firm is covered in Bermuda, but taxed in Ireland. There's very little data collected on external firms. Full audited accounts are rarely filed with the CRO. They can be very large. For example, Aircraft operates in Ireland, has assets of 69.7 billion. It's actually registered in the Netherlands and operates as a branch in Ireland. Next slide, please. That shows some data on gross assets and financing. We go to the next slide, Killian. Gross assets amounted to 20.8 billion in 2018, 14.8% of CSO estimates of the size of aircraft leasing sector in Ireland for that year. For most years, there were aggregate pre-tax losses. Losses are low as a fraction of gross assets, less than 1%. But for the period 2019-2020, losses before tax amounted to 4.6% of gross assets for 2020. Although aggregate data shows a tax charge vary period, cash tax paid is likely to be minimal. The number of firms reporting losses in the study population reached a peak of 51% in 2020. Despite most firms reporting both losses and negative equity, they continue to pay interest in Section 110 loans. The number reporting negative equity reached a peak of 56% in 2022. The deficit as a percent of gross assets of firms reporting negative equity increased from 4.3% in 2018 to 21% in 2020. These results are significant because Section 110 firms are often described as bankruptcy remote. The data for 2021 that we've started to collect in 2022 indicates a continuation of this trend. Next slide, please. Financing and interest payments. Borrowing accounted for about between 92 and 95% of external finance over the period examined. Section 110 borrowed varied between 33 and 37% of total borrowing. New equity subscribed was relatively small and reached a peak of 103 million in 2018. The median value of new equity issued for all years was zero. In fact, most firms show a capital contribution of $1 but many accounts show that this is unpaid. So they're very highly geared. The debt finance may be issued in tranches with varying interest rates and risk. The interest rate on each tranche reflects the priority with which interest and principal is paid. Many firms have issued loans with interest rates which vary between 10% and 20%. All firms have issued a PPL loan, but in most a profit participating loan, Section 110 loan in other words, but in most cases the main form of financing is the form of non-PPL debt. There are exceptions as shown in the next table. Next slide, please, Gillian. This shows two examples, and you can see that they're very variable dependence on a PPL loan. You can also see that the interest rate class C in example 1 is 18%. It's 15.6%. Interest rate, sorry, is 18%, an amount of 15.6 million. Next slide, please. Now, it's also, I might add, likely that these very high interest payments are provided by intragroup financing, not external finance. Interest rates on PPL loans is often accrued and thus adds to the level of debt structure is financing. High intergroup borrowing and asset values matching debt allows low combined equity, low contributed equity. Parent company external debt is also likely to be high. Negative equity of most firms will also be reflected in parent company negative equity. It's thus not surprising that in recent years, some holding companies with several Section 110 subsidiaries have required restructuring. Table 7 shows interest payments vary between 4.9% and 7%. Estimated interest rates for Section 110 firms that disclose both the interest and capital values, which are not all firms, are much larger, between 9.4% and 11.2% over the same period. Hence, we could argue that interest payments is effectively a distribution of profits. Next slide, please. That shows you just the date on the interest payments that I have discussed. Next slide, please. Now, I want to deal with organizational structure in Section 110 firms. In order to qualify and obtain the benefits of Section 110 status, firms must have a certain organizational features as follows. They must be resident in Ireland and they must be managed and controlled in Ireland. This is conditions met by the location of directors' meetings in Ireland. A company incorporated in Ireland and owned by a trust or charitable trust qualifies. This is described as an orphan structure. There is no legal parent. There may also be prohibitions on owning subsidiaries, I should say, or fixed assets such as buildings. For most recent years, between 31% and 37% of Section 110 for leasing firms state they're by owned or a charitable trust or simply by a trust. But in 2020, 33% of the firms, even though owned by a trust, it showed that they were consolidated. So at one hand, they're saying that they're independent and orphan structure. At the same time, they're showing that they're consolidated, that they're part of a group structure. Next slide, please. So in relation to tax havens, between 52 and 58% of firms reported a tax haven location of a parent, ultimate parent, accounting for 40% to 47% of tax of gross assets. The Cayman Islands was the main tax haven location, over 80% located in Cayman Islands, followed by Bermuda. Just a quote from the advantages of having Cayman Islands quotation. With a Cayman exempted company, there's no requirement to appoint auditors or to hold an annual general meeting, nor is there any statutory prohibition on the company giving financial assistance for the purchase of its own shares, so long as the directors are acting in the company's best interest. The corporate records of a Cayman exempted companies are not publicly available. There's no requirement for directors or officers of the company to be resident in the Cayman Islands. Location in Bermuda has similar attractions. Bermuda has been described as the largest offshore location for the registration of aircraft, in particular leased aircraft. So half of all commercial jets, 740 aircraft operating in Russia, were registered in Bermuda. Next slide, please. Chinese ownership is quite substantial. It grew from 7% in 2015 to 21% in 2020. The number of Chinese-owned leasing firms, Section 110 and Section 1 is likely to be much larger. For most recent years, between 74 and 85% of firms identified as Chinese-owned had a parent or ultimate parent located in a tax haven, mostly in the Cayman Islands for Bermuda. Now, another feature of Chinese-owned external firms, Section 110 and non-Section 110 firms, is that most firms have a matching Irish registered subsidiary. for example, a major owned in relation to expansion of Chinese-owned firms. Avalon was recently purchased, which is Chinese-owned. Was purchased by a subsidiary of China Construction. It's located in Ireland. Aston, sorry, purchased Castle Lake for 1.2 billion recently. Next slide, please. Right, local expenditures and economic impact. Killian has already discussed this. Local expenditures are extremely low indeed. Most local expenditures that we can guarantee are local, are audit, tax compliant, and corporate services, and they amounted to between 3.2 and 3.8%. That is a tiny proportion of revenue. Local expenditures may also include legal fees. Not all firms, in fact, very few firms disclose legal fees. So this will increase local expenditures because most firms do not disclose legal fees, so we couldn't include them. Most firms do not disclose directors' fees or directors pay or disclose fees. Next slide, please. Just as summary and conclusions. The airline leasing industry in Ireland is seen as an Irish success story and a key part of Ireland's industrial strategy. This despite low direct employment, low domestic leakages, and low tax payments. Well, there are very valuable tax reliefs. This paper argues that the growth of aircraft leasing in Ireland is largely due to fiscal incentives and international treaties. Aircraft leasing firms are almost exclusively shell companies. They have no employees or fixed assets. Most direct expenditures in the host country accrue to law, accounting, and corporate service providers. The main direct beneficiaries are airlines that lease aircraft with cheaper finance due to tax concessions, limited partnerships, and other firms that provide finance also benefit through tax payments. High debt equity ratios, low equity contributions, low retentions, and more recent years, negative equity due to losses means that providers of debt to these firms face high risk. The Russian invasion of Ukraine and seizure of leased assets further highlights risks from breaches of international treaties. Thank you very much for your attention.
Terrific. Thank you very much, Jim, and thank you very much, Killian, for such a rich and fascinating presentation. I was also dismayed when the CSO stopped its reporting on this. So, like what I see from your presentation is you're both continuing with that work in order to give us a good time series, but also adding a lot of new rich data ranging from ownership, location of different functions around aircraft leasing geographically, the kinds of structures, the kinds of financing, the functions of financial flows. So there's a whole tapestry there of additional data that you're pulling together. So we really appreciate you coming and presenting that to us. So we do have a little bit more time, so I'll open it up to